Let's start things off by taking a look at a 10-year chart of the VIX, commonly known as the Fear Index, which gauges volatility in the market. Take a look at that pulsing point you're seeing at the end. Huge spike in the last 2 weeks, obviously due to coronavirus fears. The last time the market saw higher volatility was back in the financial crisis in 2008. And my guest says VIX can provide a clue on where the market is going. Joining me now, Brad Simpson. He's Chief Wealth Strategist at TD Wealth. Great to have you here.
Great to be here.
We have seen, obviously, the biggest one-day drop, the biggest one-day gains that we've seen in a long time in the Dow. Do you think this level of volatility is going to continue first?
I think that's the million-dollar question. So the way to look at it is last Friday we published an article called "Certain Uncertainty."
Yeah.
Right. So I think that's probably a great starting point for it. Is I think we can be pretty certain that volatility comes with when people feel or when markets feel that there is uncertainty. So I'd say that we're going to see a lot more episodes of it. Over what time horizon? Not sure, but that's really what we're working towards to understand. You
put together a piece, which I did see the piece, and it was great, where you took a look at when the VIX is over 25,
right.
From 1990 on. I want to bring up the chart so people can see it.
Sure.
What does this tell you?
Sure.
What are you looking at?
Sure. Well, as a risk manager, and I think one of the things what investors do is when you're in times like this, you start wanting to go, well, what's kind of the downside, right? And so one of the ways to be able to do is go, okay, well, let's look at times in the past. So what this chart's doing is I think it's kind of neat, is we went back to 1990 and said, well, when the VIX goes over 25, and that's when the temperature's heating up over 25, that what in the periods after that, what are the downsides that we've experienced, and on average, what they are? So like that over time, that at the average one or the median one is a loss of 8%. So the most likelihood, call it 60, 70%. Most of the time, your loss over 25 is around that 8% zone. Your best case scenario is 3.3%. Kind of your worst is your 21.4%. And so what I like about that is if you think about it in terms of that if you're thinking in outcomes, that we're already, they're pretty volatile right now. Like, one day's good, one day's bad, one day's good. But let's say we're in a zone for losses in the S&P 500 between 8 and 12%. Mm-hmm. That means, when you're having that magical moment going, how much more of this I'm going to have to experience? What that's telling us is that we're kind of in the zone of the most likely outcome is we're there. Yeah. And so we may oscillate, but that's why we like that data point so much.
Yeah, that makes me feel a little better. Thank you.
Right.
There's some interesting data also you pulled up. You're looking at PEs, and there's the P part, obviously, with valuations, but let's talk about the E's.
Sure.
PayPal, Apple, Microsoft, everyone's kind of warning that, and I expect you might get a bit of a kitchen sink quarter, the one coming up.
Right.
Do you see a lot more downside to come in terms of companies warning?
Well, Well, I think, yes, you have that. I think we definitely will see that. But what we'll also see then in those warnings is that, like the market's expecting that now. Yeah. So in the short term is you're going to throw everything and every dirty secret you've ever had and anything that's not going well, that will get baked into it. Mm-hmm. So the other side of that then is, well, if we look at again trying to find like a frame of reference, it's kind of the same thing as the VIX, but looked at it in another way, where you say, well, if where zones we are with how much more downside we have to go. Well, we're kind of there 60% of the time with where we are at now. Maybe another kind of low teens. And then into maybe, again, your low odds chance of 20% loss, seeing an S&P 500 all the way down to 2,700.
And just because, you did some great work here, and I want to make sure we show it to people. So this is, again, your PE downside scenarios you're talking about. Let's bring it up so people can see, at 18.3 valuation, which is the mean. Then you get to one standard deviation and then a couple more down. Right. Basically what we're seeing is, to your point, we're kind of at the mean.
Right. So then it's interesting, then, because of, do you see, if you're having these earnings reports that come out poor, then okay, well, what is your earnings yield? If we're looking today, or, again, whether let's call an earnings yield today, a 6% for the S&P 500, and you look over and you look at a 10-year Treasury, like around 1%. As the volatility starts to seep away, you start doing that math and say, am I going to go out and go into an asset that has a yield of 1% that hasn't been ever in that zone, or I can go get an earnings yield, even if there's no earnings over the next 2 years if we had that printout. There's, once we get to the point of we start to understand the world and the uncertain things we're dealing with right now, I think we come out the other side of this down the road, and it's a lot better place.
You I know have talked about, I mean, you are in the business of managing risk and uncertainty. That's
Right.
what you do. And you've been on many times talking about risk factors, and you have a risk priority approach in terms of how you construct portfolios.
Right.
Bottom line, how are they doing right now?
These are good times for us, right? Our portfolios have been performing really well with minimal losses and like our phones ringing off the hook with people wanting to know what we do and how we do it, because these are the times when people come and look for our type of more wealth approach and kind of a risk priority approach.
With that, I will leave you and we'll have you back and see how things are going. Thanks so much, Brad.
Right. Thank you.